Have you scrolled through Instagram lately and seen CMHC deals advertised for just 5% down all in? Well, today Josh and I are going to sit down and kind of break this myth apart and break down the actual true cost of getting into a CMHC deal. So stay tuned. Hey guys, Aaron and Josh here with another Finance Friday, and today we want to break down the true cost of borrowing when we're getting into CMHC files. A lot of you guys might have financed some stuff on the commercial side non-insured, or if you're coming from the residential side, getting into the commercial side for the first time. We just want you to have a full understanding of what the cost breakdown is going to be, because it is probably a bit different than what you're used to borrowing with.
Yeah, absolutely. And I think the biggest jump really is from guys who were playing in the residential space to commercial, and that jump in regards to like legal fees and insurance premiums and whatnot. It's really important not only to mentally be able to make that jump, but like financially be able to absorb the cost of taking on like a larger building. Because it's great that you can scale infinitely and you can do this in a corporation, but sometimes capital requirements and constraints can be shocking, even if you're just starting due diligence. So why don't we just get into due diligence. Starting off, if you're looking to acquire a multifamily building with CMHC, it's quite a bit different than residential. You're going to need a commercial appraisal. Commercial appraisal is AACI certified appraiser. You're probably going to be around $3,000 as a base plus HST. On bigger buildings, it obviously scales to larger developments, $10,000 plus. These specific appraisers are designated to provide commercial appraisers. All CMHC files require the AACI certification. The appraisals are also required to have the cost approach if you're doing new construction, so just keep that in mind. But yeah, you're about 3,000 scaling up to about 10. All CMHC files above, I believe, 7 units require a phase 1 environmental assessment. That phase 1 environmental assessment is probably going to be around $2,000, $3,000 plus HST. Phase 1 environmental assessment is an environmental historical assessment that advises a lender if there are any possible contaminants around the property historically, looking back as far essentially as you can go. A lender is going to require this because they are wholly responsible for any sort of contamination on site, as well as yourself. So really important as a commercial buyer that you have this to ensure you aren't taking on any undue liability. Last but not least, you might not need this as like a funding requirement, but when you are looking at the due diligence of buying an apartment building and going through the CMHC process, I personally recommend getting a building condition report. The building condition report is going to cost you anywhere between $2,000 to $5,000, again, depending on size and scope. An engineering firm can do this for you. Usually the engineering firm that can provide your phase 1 environmental can sometimes do this as well. This is going to give you the expected life expectancy of every aspect of your building. And if you're buying a pre-existing building, it's going to allow you to be able to understand how old the brickwork is, how old the plumbing and electrical is. It's going to give you a good idea of capital expenditure required throughout the ownership of the property. And that due diligence cost can be anywhere between $7,000 or $8,000 before you even go firm on making an offer on a building like this.
Yeah, 100%. I mean, due diligence, it's not the same cost. You might be somewhat familiar with these reports if you've done commercial stuff in the past. If you're coming over from residential for the first time, yeah, I mean, even res appraisals are getting up there in price now, but it's not your $500 to $600, $700 appraisal anymore, right? You're getting into almost $10,000 between your first few reports, so it's definitely more expensive. I think something else to touch on too, kind of consider due diligence also, but if you're getting into construction or any sort of like major renovation conversion type projects, you're going to have some unique documents you're going to have just for these types of projects. If you have to have a QS report, you could be anywhere from like $8,000 to $40,000 depending on the size of the project and the type of firm that you have to use. So that can get pretty expensive. Your geotechnicals, your other different reports, your shadow studies, your noise studies, all those, I mean, those can run you just a few $1,000s each on those studies and reports as well too. Any sort of like architect costs, obviously you're going to be in there. You could be easily 10 grand for your architectural costs. So that's important. If you're getting into really big buildings and you're really trying to stretch the value and the leverage, you may need to have like a market rent study done as well too. Those can easily start $8,000 to $10,000 as well. So obviously the initial due diligence documents, like Josh said, those reports, easily can get to $10,000 there. If you're getting into the construction side of it, you're obviously adding quite a few more pieces to it. Again, you can get up there pretty quickly on your soft costs for your construction side. The good thing about that is that all of those costs on the development side are going to be added into your soft costs, so it is built into your project costs. But again, you do have to come up with those that money and that equity out of pocket to be able to get those reports done prior to any of the disbursements.
No, it's if you are planning properly into the line item on a balance sheet, perfect. But these are all costs that you should know that it's going to be capital up front to be able to even get started on the project. Fast forward, we get the letter of intent. You're acquiring a building or you're getting some construction financing. Very similar to any sort of like commercial loan. There's something called a good faith deposit for most lenders. That good faith deposit runs between $10,000 to $20,000 depending on the project size. What this is quite literally good faith, meaning you are providing capital up front to ensure that the work that is being done on the back end, which is significant by the lender, essentially you're committing to them and you're not going to be shopping it anywhere else. This is going to allow them to be able to commit to getting any sort of legal accounts started, any sort of reports pulled, staff who are working on underwriting and checking the reporting on the building itself. That good faith deposit is fully refundable. It does go towards the closing at the end of the project, so it's not something that's an additional cost, but definitely something you should keep in mind when you are looking to even just sign paper on progressing forward with a project like this. When you fast forward and you get all the way to the end and you get your commitment, there's also a standby fee. So the standby fee is usually the difference of 1% to 1.5% of the total loan amount. So if you're looking to play big boy real estate and you're having a $10 million construction loan, the difference on that, there's about another $90,000 you're going to have to put down to come up with when you sign your contract with the lender. This is essentially to allow them to continue the process and have any sort of buffer if you're rate locking and whatnot down the road. But some sizable capital requirements would be required upfront before even getting capital back. And sometimes this is kind of an overlooked thing where clients are so far into a project and they have all their money in, they don't realize that there's actually a bunch more capital you have to put in before getting the capital back on the refinance of a building. Yeah,
100%. I mean, just to touch on that too, that 1% standby hedge cost, that one is fully refundable, so it does get back to you on funding. But a lot of guys do get a surprise. I mean, if you're anywhere from 10 million and above, you're roughly 100 grand out of pocket just to be able to move the project forward, and not everyone is fully prepared for that. So just keep that in mind. And again, it is fully refundable. Moving the project forward a little bit, I mean, I guess we could even touch too on rate lock and just keeping your eyes on the interest rate environment. We're shooting this on a Wednesday. Last Friday to Monday, we just watched the bond shoot up 17 points. If you had any sort of low-ish ceiling rate and you're really trying to squeeze a project, you might have had a bit of a shock with a buy down coming through. So understanding how the buy down works and just paying attention to as much as you can to the news, unemployment numbers. Anytime Trump seems to speak, there's always a bit of an increase in bonds typically. So, just kind of listen to the news. But, having that conversation with your broker, if you start to see bonds moving, or, having the understanding of where are we submitting our ceiling rate and how much movement do we actually have, is all going to be an indication of, if you may have a buy down coming up to be able to bring your rate back down towards the ceiling, and potentially how much that's going to be. Because again, if you're on these 10 million plus projects, your buy down is $100,000. So again, an unexpected cost on refinances, it can come out of the equity. So it's not a out of pocket transaction, but again, just making sure you're keeping that accounting for.
Yeah, I mean, one of the challenges with the whole buy down situation is, it only affects you in an increasing bond yield environment. And, what happens is a lot of investors, a lot of developers are trying to maximize the equity takeout or the loan size available to them with the product, which I understand, the advantage of taking the product is increased amortization, lower debt service coverage ratio, like intending the use of the product, but with the lowest max rate possible, it puts you in a situation, an underwater situation on the buy down. So, it's definitely a risk that has to be chatted about more, especially just due to where we're at with, rising interest rates. That being said, my favorite part, the favorite people in the entire world, lawyers, legal fees, and all the fun stuff to go along with that. If you have closed any retail real estate investments, you would know that you have to have a lawyer to close your transaction. Same goes for commercial real estate, except they just cost more. There's a lot more that goes into actually closing these types of transactions depending on the work that needs to be done on the back end. Odds are you're going to be responsible for not only your lawyer, but also the lender's legal fees as well. It seems as though they keep increasing the cost of the transaction as a whole. Right now you're probably okay to budget $10,000 per side for a mid-sized building. So keep in mind that obviously that can fluctuate a little bit here and there, but if you're looking at $7-8 million building, the lender's legal fee is most likely going to be at least $10,000, and your legal side, depending on the relationship you have, how much business you do with your lawyer, between $5,000 to $10,000, depending on the complexity, how much work is involved in closing them. One of the biggest shockers for most people who are getting into the space is just the sheer size of the legal accounts to close some of these deals, and they are quite complex. They do take a few weeks to close. This isn't something that your lawyer can just pick up and close in 2 days. This isn't, it doesn't quite work like that. So, the legal work involved on the back end for the service providers that are helping you close your loan can be significantly more than what you're used to.
Yeah, and that's just, the cost of closing the transaction. That doesn't look at any sort of, legal corp structure, setup, anything like that, right? If you don't have a pre-existing corp or you're getting into a GPLP, you could easily be another, $10,000 to $20,000, $30,000 just to set up a corp, obviously depending on the size of it, but I think to your point, it does catch a lot of individuals off guard for sure.
Yeah, absolutely. I mean, a great point just in regards to corporate structure alone. Obviously, you can get into the levels of depth in corporate structure, but most clients have a corporation or they open up a corporation to be able to do this, which can cost thousands of dollars to have it done correctly and structured done properly. So, all things to keep in mind.
Yeah, and I think this is from myself and from Josh, we obviously kind of get frustrated when you see people talk about CMHC 5% down, come in, close, buy. Yes, you can get into buildings with just a 5% down payment equity position. Construction side, yes, 5% equity, but on the construction side for sure, all the reports and stuff that we talked about, your soft costs are definitely $300,000-$400,000 plus land down payment. You can easily be $500,000 in cash out of pocket, and that might be more than that 5%, right? Depending on the project size. So just understanding that 5% down payment doesn't necessarily mean you're not going to have it. Well, not even necessarily. It doesn't mean that you're not going to have additional costs. There's definitely going to be additional costs there. So again, if you were calculating the expenses and just upfront capital, we were 1%, 100 buy down potentially. We were easily in the six figures there. So on top of your down payment. So again, they are capital intensive projects. It does take time. Be prepared. The last thing you want is to be scrambling around trying to borrow money at 12% because you have to come up with a couple $100,000. So just make sure that equity is available.
And last but not least, something probably the most important part of them all is the insurance premium. So one of the advantages obviously of taking, or multiple advantages of taking CMHC debt, is the wonderful benefits that come along with increased amortization, higher loan to value, loan to cost ratios, lowest debt servicing that you can get on the market. But there is a cost to this. This isn't free. This is something that you are paying for, and you're paying for it through mortgage default insurance. Now that insurance is the CMHC fee that is added on top of your net loan amount. Unfortunately, this isn't free. This is something that goes to the Crown Corporation, which is CMHC. What the insurance technically is it back defaults not you, but it back defaults the lender. So it guarantees that the lender will not take a loss if you default on your loan. They add that on top of your net loan amount from yourself. So when you're looking at your commitment or you're looking at your letter of intent, you're going to notice there's net loan amount, there's insurance premium, and then there's gross loan amount. Your payments are all based on the gross loan amount, meaning they add the insurance premium on top of that. Now your insurance premium works in a few different ways. The MLI program, it's based off of 50 points, 70 points, 100 points, and it's a sliding scale. The more points you get, the smaller your insurance premium. The higher the points you get, the larger the insurance premium. The MLI Select insurance premium is significantly less than the standard premium. The standard premium is based on also a sliding scale based on loan to value. The higher the loan to value, the higher the insurance premium. And then they also add 25 basis points for every 5 years on top of your 25-year amortization. It ends up being about 6.6% for the maximum leverage, maximum amortization, which obviously, you know, on every $1 million can be a significant amount of money. So, you know, ensuring that you understand that insurance premium, even though it doesn't affect your net loan amount, it's still something you need to pay for, and it's added on top of your loan amount, and then you have to pay it every single month throughout the term.
Keeping on the CMHC fees, last one there is obviously the application fee. It depends on the amount of doors that you have, but you know, on average, if you're budgeting for about $180 per door, that's going to be your cost. For applying to CMHC, that is due up front when we submit into the lender. It is added back into your overall gross amount on the loan size. But yeah, just, you know, last but not least there for CMHC. And then your last few costs are going to be your lender and broker fee. You know, these fees, it really depends on the loan size and the complexity of the deal. Typically your lender fee doesn't really get to be much more than 1% on some of the smaller ones. You start getting into the, you know, 30, 40, 50 plus $1 million loans. Sometimes the lenders may not even charge, or, you know, maybe it's just a nominal application fee. Maybe it's, you know, $10,000, which, you know, on a $50 million deal, it really isn't a huge number. Sometimes you can actually build that lender fee into your basis point spread as well too, if you really wanted to. Obviously, if you have lots of debt servicing and you know, the building's okay from that standpoint, you can build it in. Your basis points spread on top of the CMB is cheaper if you do pay the lender fee as a separate line item. And then your broker fee, again, you know, broker fees are anywhere from, you know, up to about 1.25% of your loan size on most deals under, you know, roughly 10 million. The larger the, you know, the deal, obviously, you know, we're trying to make it economical, but again, you know, budgeting somewhere around like 2.25% total for your loan size up front is a good place to start. And then having a conversation with your broker to be able to dial those costs in is probably the pathway I would suggest.
Yeah, absolutely. You know, I think, you know, having an understanding of the total cost of doing these projects is really important. It's great that, as Aaron said, you know, people are out there selling these products, and, you know, buying an apartment building is a great idea in theory, and I think in reality too, but there's more to it than just being able to put your 5% down or just, you know, buying an apartment building. These are the most capital intensive investment projects you could possibly make. You know, construction financing, nothing ever happened as fast as you wanted or as cheap as you thought. You always need capital to do it. And, you know, closing these transactions can be quite costly, but if something is worth it, it's probably not cheap or free. So, you know, Aaron and I are here to be able to help you guys navigate these waters, and we wanted to make sure that it's very clear the total cost of actually trying to transact with one of these things. Clarity in the market is going to help everybody progress forward, and there's a lot of opportunity out there moving forward in the market. You know, there are great deals to be had and a lot of development being stirred up across the country. So, you know, really appreciate you guys taking the time today to chat. If you did like this video, please hit the subscribe button, hit the like button. It allows Aaron and myself to be able to shoot more content like this for you. Appreciate you guys watching.